Good evening, ladies and gentlemen. Michael Silva here. So if you've been living under a rock, you probably don't know what's going on right now, but a lot of companies are reporting earnings, and a common theme that we're starting to see here is, well, we hear that you're under pressure. Yes, many consumers are under pressure. So we're going to dive into that and what it can mean for the potential stock market on today's Stock Market Brief episode, where we navigate the financial markets through the lens of technical and intermarket analysis. Before we hop into today's show, make sure to check the links in the description below. That's where you can access the swing trading community. And also check out my partners, Interactive Brokers, where you can view their campus, bunch of tools, resources, and a great brokerage if you're looking to have a new broker. Let's get into today's episode. All right, people, welcome back. So there's been some interesting shifts in the market as we went on a monster rally with no pullbacks, and now we're beginning to see, well, some volatility. And I wanted to kind of show you some things because the market, in yesterday's video, we talked about it potentially ripping. We got that rip. It could still continue, but I want to show some interesting charts. This is a rotation chart, relative rotation chart. So it shows us where strength is improving, leading, weakening, or even lagging. And I'm looking at the last 5 trade days, so very short time frame. And what you'll notice here is in the very short time frame, we have actually utilities and consumer staples up here in the leading quadrant, more towards the leading corner versus the majority of other sectors. Now, if I want to zoom out and look at a weekly, so we'll look at the last 5 weeks, take a look here at utilities' big move into improving, right? And then energy has been really leading the way up here into the leading quadrant as well. And then we have consumer staples also shooting there. We have XLB, but the big dogs like, technology, XLY, they're all in the lagging quadrant. And what I found so interesting about this specific chart here, seeing XLU, XLP in the shorter time frame, but then even they're improving in the longer time frame since we really saw this dip, right? Since the start of the dip. Why I find this interesting is if you look at a rotation analysis chart and you look at the 11 sectors, okay, typically what performs the best at market tops is energy. And we've shown many charts of when energy outperforms the S&P 500, how that's not good for the stock market. So I'm not going to dig too much into that. But as we start to turn on these market tops, you start to see names like consumer staples, healthcare, utilities start to outperform quite well at these market tops. Now, I don't know if this is going to be a cycle top in the market by any means, but this is interesting to point out because we are seeing rotation and relative strength in those sectors. But another interesting aspect here is utilities. Typically, when utilities becomes the top dog, which utilities has been in the short term and it's improving greatly here, even from an absolute perspective, this actually matches up with the economic cycle over here at roughly the top into potentially the turning point into early recession. Now, I don't know if that's going to be the case. So if we dive into, the expansion and contraction chart, again, we brought this into leading into 2022 that led us to that bear market. But stage 4 and stage 5 are interesting, right? This is where bonds go down, which we can say that bonds have been going down, but commodities and stocks go up. Well, right now, stocks are actually going down. Bonds are going down, right, in the near term, in the short term. But one could argue potentially that stocks have been going up, they're just pulling back. So stage 4 or stage 5, and this is when commodities also go up. And a lot of commodities have been going up. And when the late stage, you get commodities to fall, bonds to fall, stocks to fall in the late stages of that cycle. So stage 4, it marks a period of full expansion. Both stocks and commodities are rising, but bonds turn lower because the expansion increases inflationary pressures. Stage 5 marks a peak in economic growth in the stock market. Even though the expansion continues, the economy grows at a slower pace because rising interest rates and rising commodity prices take their toll. And well, we've been seeing things like copper. We've been seeing things like oil rise. Now it's kind of backing off a little bit these last few days, but still rather pretty strong. Now, keep in mind, they stated here that this is the ideal business cycle in an inflationary environment. And why I'm saying it's an inflationary environment is because, well, if you look back at the core inflation, which excludes food and energy back 10 years, right, we're at a rate that we haven't seen for quite some time. We're still relatively high when the goal is to get down to 2%. And the way that the Fed is trying to fight inflation is by keeping rates higher for longer. And the Fed Fund Probability Tool is really pricing in one rate cut here in September into November and December. So one rate cut here for the remainder for into this year. And this could change if inflationary pressures increase. And we do have obviously some important data dropping out come tomorrow, which could change this. We have jobs numbers and we'll get into that. But as this is taking place, as inflation is taking its toll at higher, and when rates are being held higher for longer, this, like I said, is putting pressure on the consumers. Okay, so let's dig a little bit more into that of what that might look like from a stock market perspective, right? If you look at the federal funds rate down here during a hike cycle, and you look at the 10-year, 3-month yield curve, we typically get those inversions at some point, and then we pause. You can see pauses. And during the inversion, it's actually when we uninvert, which is actually the issue. And when we uninvert, that lines up pretty well when we start getting rate cuts. So they're saying we may get a rate cut this year. Maybe we do, maybe we don't. We don't know. But one thing is certain, looking back through history, in the 2008 great financial crisis, in the 2000 dot-com bubble, even going into the 90s over here, the market was making all-time highs with an inverted yield curve. But when it uninverted and when we started cutting rates, that's when pressure started to really arrive in these markets. And yeah, we're in a presidential election cycle, but I want to remind everybody that this was a presidential election cycle, and same with 2000 was a presidential election cycle as well. So going back to the consumer, we can look at something like small caps. And small caps, they have not met an all-time high yet with, in comparison to all the other markets. And you can see here what I find interesting about looking at, the Russell 2000, because it has a good gauge on the economy, is when we have these inverted yield curves, right? Inverted yield curves. When do you see the stock market, when do you see small caps or the consumers start to see pressure? Well, as it's rising, right, you can still have the market go higher. It's when we start to level out, okay? And then you start seeing volatility arrive. And then as we uninvert and we start slamming rates, you get these brutal reactions. And then when rates are down here at 0, when they're slammed to the floor, we'll look at everything go here. Now, why is that? Well, because when rates are low, when the federal fund effectively slams rates to 0, this encourages spending, right? When rates are low, it doesn't encourage savings. When rates are high, it encourages savings because you can make more on your money when it's in the bank. When it's down here, things are cheap. Even things that are very expensive. If you're buying a loan on a car, if you're buying stuff on your credit card, rates are a lot less. So look at over here, we slammed rates, inverted yield curve. We saw all this volatility. And then right now we're still well inverted, as we've already stated, and we haven't even began to cut rates as it stands. So yeah, the consumer is feeling pressure, and you could see that also looking at something like credit card accounts. I mean, we're breaking records here on new credit card accounts. So typically, right, if we're why are we reaching for more and more credit card debt? It's an interesting take, right? Like, why are they reaching for more and more credit card debt? And you can even look at like what we've seen in the past as the quarterly change in deposits were actually decreasing or going significantly decrease year over year perspective. I haven't seen a recent update on that, but we have credit card accounts starting. We have less going into bank accounts, and then right, if that was just the credit cards, we're not actually reaching out for auto loans, which this is an interesting chart from the New York Fed Consumer Credit Panel. Auto loans aren't really being reached for, and I have a theory as to why that may be. Credit cards, obviously, accounts are opening up. So these are getting more expensive because why? Well, interest rates on the 60-month auto loans, they're at highs that we haven't really seen since, the great financial crisis. So yeah, perhaps cars, right, it's going to start to level out. People aren't going to start reaching to buy more vehicles. They'll start reaching for credit cards because, they can spend more of that money. Now, the unfortunate thing is credit card interest rate is also sitting at a high that we haven't seen since we haven't seen ever, right? This is the highest we've seen. It's at roughly about 22.5%. That means the more credit that people have, the more that they're going to have to pay. And if they can't pay it, what happens? Well, we start to get delinquencies. Okay, so if you look at the 30-day delinquency over here, look at auto loans, right? So people that already have auto loans, credit cards, and you're starting to see these rise at a pretty rapid rate, pretty rapid increase. Even mortgages are starting to turn up. Student loans haven't moved because, there was that student loan program and we have this forgiveness stuff going. They did have to start paying, some of them had to start paying it back, but that could be one of the reasons there. Go into 90-day delinquencies. It's even seen a sharper move in credit cards that we haven't really seen. You have to go back to 2011 or when we started to see this last type of increase was going into the great financial crisis. And then if you look at stuff like third-party collections, you can see that the percent of consumers with collections is not that much, but the people that do have collections, that's rising at a very rapid rate, meaning what? It means that the people that are struggling hard, and the people that aren't struggling, they're getting by. Okay. If we take a look at credit card loans, 30-day delinquencies over various banks like Capital One, Discover, Bank of America, JP Morgan, American Express, these have all been on the rise. Okay. 30-day delinquencies all on the rise. They're starting to come off a little bit. However, that's not necessarily telling the full story, because if you look at net charge-off rates, look at Capital One, look at Discovery, look at Bank of America, look at JP Morgan. These things are firing off, and especially Capital One and Discover. Talking about Discover, we haven't seen moves like this. I mean, you'd have to date back to the financial crisis there for net charge-offs. So yes, the consumer is feeling the pressure with these higher rates. Is it going to be a problem? It's hard to say. It's very hard to say, but we'll get into very key levels in the markets to be aware that if things start to crack, it could get potentially worse. But I thought that was all interesting data that I wanted to share there. If we get into what happened today in the markets, the 11 sectors that in the S&P 500, technology led the way, consumer discretionary and real estate. So risk on for the most part overall. Everything was up, green across the board. If we take a look though at like the NASDAQ composite, okay, this is a good broad look at markets. We had this head and shoulders type pattern. We haven't even retested the neckline yet, and we're kind of, forming somewhat of a bear flag here. So I think that with Apple earnings being positive, perhaps so we start to see markets kind of move up, maybe retest these levels. But it doesn't mean we're really just, out of the woods yet on this increased volatility. A NASDAQ McClellan summation index did cross over and have the parabolic SAR tick over. So is this highlighting a potential change in trend? And we bounced from these oversold, levels from the NASDAQ McClellan oscillator. So is this, as we've seen changes in trends before, they've been whipsaws, but they've identified potential changes in trend. This was the last change in trend over here, or a little bit before. Market sunk off. Now we're getting a bullish potential change in trend that we want to pay attention to. Now, while it's happening, if you look at the old fool indicator, this is taking the NASDAQ composite, dividing into the put to call ratio, applying some moving averages. We have, when the green line crosses under the blue line, it could be a sell signal. That was the last sell signal over here, which led to the 10% correction or so. Then we had a buy signal, the market rallied. And then right here, we started to get some chop, but our first initial sell signal in 2024. And as that crossed, we saw volatility and the market started to sell off. And I'm calling this out is because we are still holding more of a bearish crossover. So if it does move up higher, just be aware that if this continues to trend down, it could be an early indication that the market still may have some more downside to potentially go. Now, if we look at the S&P 500, right, we had about a 6% correction or so. Market's chopping around. You might look at this as a potential bear flag. If it starts cracking under 5,000, that is the key level because it's a put wall, and we'll go over that later. That opens the door to retest these lows and potentially lower, but we're kind of just holding our head right around this trend. And it looks like tomorrow we'll probably gap above this because of Apple earnings. If you look at the weekly time frame, we're still under the weekly 5 EMA. Okay, we got, outside of it, we snapped back, we snapped under it, we're coming back into it, so we'll see where we open and where we trade around. But we're really just trading within this very volatile trading week there. So prices expand, and now we are contracting. Not quite out of the woods yet, but we're making progress. With that said, we are under the gamma flip line, and when you're under the gamma flip line, you see monster rips to the upside, but you can see monster sell side activity too. Selling but gets selling, buying but gets buying, and you get these pretty crazy moves overall. So 5,100 will be a key level to tune into. Above 5,100, that can open the door to 5,200. 5,200 is our net call wall, and if 5,100, which is right here, if we can get above this and hold it, and traders continue to reach out here, that can give us insight that we might move another 100 points or so in the S&P 500. So that'd be the bullish case. Now, on the flip side to that, 5,000 over here, which we had mentioned, is the put wall. And the put wall is just under really the weekly expected move. You can see the S&P 500 has been playing and doodling around the last couple of days at the lower weekly expected move. Today, actually, on today's gap up, it was faded just to under basically the weekly expected move. Now, this set up for an excellent trade opportunity to the upside. So if you managed to watch the live stream, we talked about that in detail. And what gave us the insight was market net flow. So let me bring market net flow up over here. You can see as the market was selling off right here, market net flow wasn't suggesting it being too bearish, right? We had a bullish divergence, no convergence. So as we pulled into those levels, I looked to go long myself and hold, a decent portion of that. And as the day progressed, we started getting convergence, and we had a bullish divergence continue throughout the day that led to a nice rally. So incredible move there in the markets today. And this tool really helped us get on the right side of that specific trade. Now, going into tomorrow, we have non-farm payrolls, unemployment rate, ISM services, right? We have a lot of different data coming out, and this is going to be very critical because we can wake up 40 points, we can wake up down 40 points, or even more if it's a big shock to the market. The daily expected move for tomorrow's report, right? And it's the last trading day of the week. We've already tagged the weekly expected move. So the market, is in its happy place. There's a higher probability we close within this. If you don't know what that means, go watch my other videos where I talked about this at the start of the week. But going into tomorrow, 509.67 to the upside, $500.39 to the downside, which is back to where the weekly expected move is at. Now, I drew this little box here because that box indicates where we're trading right now at this current moment in the after hour session. Why are we trading up here? Well, Apple reported and the market ripped on that news. So if we open up, we'd be back above a 5-day moving average. That's rather neutral. So being under it, right, you're bearish, but with caution, okay? Caution meaning that we're below it, but it's not trending down, right? If this is trending down, it's a little bit more bearish, okay? So what we want to see, if you're bullish, you want to be above this rising 5-day moving average. You want it to start rising again. And you also want to be in positive gamma territory. And that flip line is right at around 5,100. It'll probably update in the morning to see more specifically where that's at. Once we get above that, you start to look to buy the dips, sell the rips, buy the dips as volatility suppresses. I'll close off with here. These are the daily expected moves. This is something that I share with my Discord group every single day. So I'm going to share these with you going into this big report. The reason why is because it's a big report, right? Big moves right here. $43. This is plus or minus. And I'm giving you the 2 sigma levels too as well. You have the futures right here. You have the SPY. So these are the levels that we talked about. So you can screenshot this. Qs is looking at a roughly $5 expected move. And even IWM is cranking up to $2.81 expected move. Remember, in terms of distribution, 68% of the times it closes within the upper and lower levels as one standard deviation. But we add this too, because if the market gets surprised, these are some important levels. And they'll close within these 95% of the time. That's just standard probabilities there, okay? That's all I got for you on today's episode, everybody. Hope it gave you some insights to what it is that I'm seeing in these markets. Make sure to like and subscribe to the channel if you haven't done so already, and check out our partners, Interactive Brokers, or even come out to the swing trading community. That's all I got for you. See you later.